probably know, it was an up and down day for Wall Street and global markets. As soon as trading began this morning, the Dow Jones lost more than 1,000 points. That's the largest single drop it's ever seen. Global markets suffered as well. Investors appear concerned over the economic situation in China. Shanghai's main stock index fell 8.5%. So is this the beginning of a period of decline, or was this the natural, quote, correction many experts have been expecting? Joining us with their take on the market roller coaster and how it might affect you are Edward Stewart. He's Professor Emeritus of Economics at Northeastern Illinois University. Nancy Coutu, she is Principal of Money Managers Financial Group. And Michael Miller, Associate Professor at DePaul's Driehaus College of Business. And welcome all to Chicago Tonight. Welcome back to Chicago Tonight. How about it, Edward Stewart? Have we ever seen a drop like this before?
Yes.
We have?
Yes. 2011, the stock market dropped 8 or 9% before, and this stock market has had a pretty steady upswing for 5 or 6 years, and there's kind of a perfect storm going on with commodities prices and weakness in China and weakness in Europe and a threatened rate hike by the Federal Reserve. And so all of these things together, plus if the U.S. economy is still not robust, and there's some doubt as to how much more growth there is in the U.S. economy.
A perfect storm, Michael Miller. After all, 1,000-day drops don't typically happen in the stock market.
No, but corrections do, and corrections are defined as any drop in the market of greater than 10%, but less than 20. After 20, you're in the field of a bear market. As Ed said, I think the average change or increase over the past 5 years has been 17%, dividends included, which is a very good run compared to the 10 to 11% historical average. It's just that the economy is, it doesn't reflect the economy, it reflects the psychology of what's going on in the world.
Your sense of the economy is slightly different from Ed's, and we'll get to that in a second. But let's take a look at just some stock market bullet points in terms of history. As Michael just mentioned, a correction is a 10% drop from a recent peak. The average bull market lasts 4 to 5 years, and ours was 6 years in the making, 6 years plus, and the average bear market lasts 14 months. How about it, Nancy? Is a move like this startling for people who don't pay close attention to the markets every day as you do?
It's startling to everyone, whether they pay attention daily or not. We all feel the pain when the market goes down. No one likes to accept it, but it's part of reality. It has to go up, it has to go down. This is the longest bull market we've had since 1957. It was way past due. Certainly we were communicating to our clients for the last 12 months that we expect it. Certainly since May, it was an indication. It wasn't overnight. It was a slow drop. And then, of course, Thursday, Friday, and today were kind of a bloodbath, if you will, in the market. And it was definitely a rude awakening. Well,
certainly a blood shower, if not a full bath. The Dow fell 3.6%, the S&P fell 3.9%, and the NASDAQ 3.8%. Edward Stewart, why is a correction a good thing?
Well, it builds some reality into people's expectations. The example that I use right now is the Chinese stock market. They're brand new stock market investors in China, and like real estate investors in the United States in the 2000s, they had this idea that prices always go up. I tell my students that we're lucky in an educational sense to have lived in the last 10 or 15 years, because we've had a real estate crash, gold prices have crashed, oil prices have crashed, we had the dot-com bubble. So there should be a certain amount of skepticism and historical perspective that markets go down as well as going up, and market economies are inherently unstable.
Michael Miller, more on why a correction is a good thing.
Well, you want the market to reflect the fundamentals of the economy, and sometimes you can get into momentum. Just because it's going up leads you to buy more, which makes it go up even more. And when you add in one other thing that's clear is that there's been really nowhere else to invest your money. With bond rates so low, even though they're very safe, people were chasing yields, and one place to put your money then was in the stock market. So even until about a year ago, I was 90% in the stock market, even though I hope to retire soon. I did get out, and I got out obviously in time.
All 90%?
No, I'm down to 60. So
down to
I'm still going to hurt. All of us are going to get hurt by this. But there was, and there is.
How much time do you have before you're planning to retire? How much time do you have to bounce back?
6, 7 years.
Okay.
Yeah. So I'm going to be 62, and so I figured late 60s is when, if health works out. But the correction, you want the economy and prices to reflect fundamentals, and sometimes it just gets out of whack.
Nancy, have you been telling your clients, because stock market, the bull market lasts 6 years, you look at your 401k and boy, it's going up, it's going up, it's going up. At some point, are people getting a little, at some point do people get a little greedy?
Yes, and people, again, forget that the market goes down, as in 2007, 2008, 2000, 2001, 2002. We remind them of that, and then sometimes people overreact because of that. Some people have already gotten out because they don't want to relive 2008, which I think is totally different. This is apples and oranges.
Why is it apples and oranges?
2008, we had a whole lot of problems. Financially, our financial market was almost manipulated at that point in time. We were in a recession. It was a totally different environment. Economically, we're sound. People are going back to work. Unemployment is low. Interest rates are maybe going to be edging up, so they make a little bit of return in that area. But they have to understand that this hopefully will be very short-lived. And if they are putting money in their 401k, if they were putting it in something safer like their money market or stable value, they need to, now is the time to be adding to the market. They want to add when it's down, and if they're ever going to take out, they want to take out when it's up. It's hard to be contrarian.
Edward Stewart, it's pretty risky to make short-term predictions about the market, is it not?
It's impossible to make short-term. You shouldn't make short-term. And for most people, the stock market isn't that important. I mean, I worry much more about my students graduating and whether they're going to find jobs. The ownership of stock in the United States is, like every kind of ownership in the United States, ridiculously unequal. So the focus on the stock market is important, but shouldn't be our main focus. Our main focus should be on what Adam Smith said 200 years ago, the standard of living of the average citizen and worker in the society, and that's not doing very well. Stock market has done fabulous in the last 6 years.
Mike Miller, let's step back for a second, because we really haven't discussed why this is happening. Why is it happening?
I think it is psychological, that people think that China carries more weight than it does. It's only 7% of our total exports, which is 1% of GDP. And when people see the second largest economy in the world staggering, and I'm not sure they know what to do, and you see money leaving China, so the Chinese are creating huge quantities of liquidity. They're flooding the market with liquidity. This scares people. And when you're afraid, you move out of your position. You sell your stocks, because those are the riskier instruments. So I think it's purely psychological, because it's not tied to the fundamentals of the economy.
Nancy, do you think it's purely psychological?
I do. Truly, I totally agree with that, is that people, I think that uncertainty creates fear. So people hear China, people hear energy, people hear interest rates potentially going up, which is going to affect our market. And people think, oh my gosh, there's too many bad, negative things going on. I should come out of the market, which I think it is psychological, it's not economic. Edward
Stewart, you're grinning.
The best thing about this is that it's maybe taking some pressure off the Fed to raise interest rates. There is a backup. There was an excellent article in today's Financial Times by Lawrence Summers about why this is exactly the wrong time for the Fed to raise interest rates. Now, I don't really care that much about the stock market, but I do care about the economy. And raising interest rates is a bad thing to do for employment, for economic growth, for business formation. And so this market catastrophe, quote unquote, may give the Fed leadership some latitude with regard to backing off from this quote unquote September interest rate rise.
Michael Miller, is it a good thing for the economy to be operating with such a low interest rate for so long? Is there a downside to that?
Well, you want to make sure that the Fed is not causing an over-investment. In other words, if interest rates are too low, people may see this as a time to invest in things that they don't really need just because the money is so cheap, and then you get further into the economy and they don't have to buy at a later date, or they bought the wrong combination of inputs. So you can get what they used to call in our theory classes malinvestment. You can get money spent the wrong way, and then we have to eat that or absorb that later on.
Nancy, have you gotten phone calls today from people?
No, actually not one, because we've been educating our clients, and we balance their portfolio. We do retirement planning predominantly, so Most of their money was off the table anyway.
And when you say off the table, what's the allocation?
Safer alternatives. So our allocation, we take the rule of 100, 100 minus their age. So if they're 60 years old, 40% maximum should be in the market. And it also changes based on if they're still working or not. So especially if they're still contributing to a 401k, they should be definitely contributing to the market side. But knowing that most of their money is off the table and what is in the market is our long-term bucket, if you will, they're fine. I made a lot of phone calls today to the people potentially I thought might be nervous, and they were like, we're fine. This is our long-term bucket, right? This is,
the stock market is a long-term budget.
Right.
Okay, but you say you're advising people to put their assets into safer markets, but those safer markets usually don't pay very much, if anything.
The next best thing to making money is not losing it.
I suppose that's true. By the way, is there anything to stop a bank from paying higher interest rates if they wanted to?
Competition. There's no reason to. They think of that as the price they have to pay to get money, then to lend it to you and me. If they can borrow it from each other at 0, which essentially they can, or 16 basis points, why should they pay you more to get that money?
But might there be a competitive niche for a bank to say, you know, we're going to offer 2%?
Only under one condition, if they need the money. If you had a bank that didn't have sufficient deposits, or sufficient deposits of a certain kind, people involved in CDs of 5 years or 10 years, whatever, if they needed a certain portfolio bump, they could offer it for this very specific kind of money, and then that would, once they got as much as they need, they would remove that incentive.
You know, because, I mean, one reads that some folks would say, you know, if banks are paying 3 or 4% interest, something respectable or notable, a lot of people might get out of the stock market altogether. Nancy, do you ever hear that?
Oh, all the time, absolutely. People put money in the market for the wrong reasons, and again, especially when it's up and it's up and it's up, and they think it's going to continue up. So it's constantly for us an educational process to remind them that it's going to go down. It's not if, but it's when. It has to go down, it has to go up. We want to make sure that they're aware that when it goes down, it's not going to affect their overall portfolio because we have it well diversified.
Okay, might this, as the market is dropping, or as it has dropped, I mean, we'll wait to see what happens tomorrow. Nancy, is this a good time to buy?
It's an awesome time to buy. So if people have cash on the side, they need to think about moving it in. I think we're still going to see some downfall maybe for this week, but you never find the perfect time to buy, nor do you find the perfect time to sell. When it's 10% down, it's a buying opportunity. I mean, they can look at a portfolio of unbelievable quality stocks, and they're all bargain basement prices today. Yes, they could go down further, but certainly they're a bargain today. As long as I'm within the company of educators, one of my favorite finance professors, Jeremy Siegel, said volatility creates enough people getting out of the market that it creates a superior environment for people that stay in the market. So it's about know that you don't come out when the market goes down, you go into the market when it goes down, and you come out when it goes up.
Absolutely the case, because what people would be doing right now, there's a good chance that as the market was rising over the years, they would be selling low instead of selling high. And so that would be you bought high and you're going to sell low. That could be the worst thing that you could do.
Okay, you've all been very calm and rational about this, and maybe our viewers at home are sort of taking a breath and that sort of thing. Is it premature, or is it just wildly improbable that this might be the beginning of a recession?
Could be.
It could be the beginning of a recession?
Could be.
Okay, now you're scaring me.
And if the Fed raises interest rates, that makes it more so. And if we get some kind of a fiscal cliff or sequester or budget freeze, that might do it as well. But there's no necessity, there's no natural inclination for the economy to go into a recession just because there's a stock market correction. There was a huge correction in '87, right when Greenspan took over the Fed. But because monetary policy was easy and interest rates were cut and there was enough liquidity in the system, the economy kept going in the late '80s just fine. So there's no reason for a stock market per se to cause a recession.
Mike Miller, we have 10 seconds.
Sure.
Prospect for a recession?
I've looked at, there's actually an index called probability of recession. It's 1.3%. It's just not in the books right now.
That's encouraging.
Yes.
On a discouraging day. All right. Well, ostensibly discouraging, maybe not. Edward Stewart, Nancy Coutu, and Michael Miller, thank you all for being here. We appreciate it.
Pleasure.
Thank you very much.
And Chicago Tonight will be back in a moment with a possible solution to Illinois' budget stalemate, so please stay with us.
This evening's presentation of Chicago Tonight is made possible in part by ComEd.